Hello, Namaskar. Welcome to this Think and Link series. I'm your host, Srinivasan. Today, we are going to talk about a very important topic interest rates. Should the repo rate be cut? So, we are going to demystify interest rates. That will be our idea. And then take up the question of whether the repo rate should be cut. Now, this question of should the repo rate be cut has been grappling the market for quite some time, at least in the immediate aftermath of the release of the MPC minutes of the meeting, that is the Monetary Policy Committee minutes of the meeting. And two of the members of the MPC committee clearly indicated that repo rate needs to be cut. So let's examine the validity of having a repo cut. But first, let's start with demystifying the concept of interest rates. Now, quite simply, the definition of interest that is received can be defined as an incentive for the lender for having lent the money. And for the borrower, it is the cost for having taken the monetary resources from the lender. This is the simplest definition of an interest. Now, be that as it may, we need to know that interest rates has three important components. First is the real interest rates. The real interest rate is the interest that the investor expects to receive after allowing for inflation. So, the real rate of interest should, in all probability, be the same throughout the world globally, whether it is in US or China or India. I mean, of course, you have to factor in the political system as well. The second is the inflation rates. Now, this is the price level in a country, and this differs from country to country. And lastly, risk premium. The rate the investor expects over and above the riskless return. Now, this changes depending upon the credit worthiness of the borrower. So, in short, when you talk about interest rates, it is nothing but real interest rate plus inflation rate plus risk premium. So, if you take a personal loan, let me give you an example, and the bank charges, let us say, 10% rate of interest. This simply means that your interest rate comprises of a real rate of interest of, say, 2%, inflation rate of, say, 5%, and the balance 3% is the risk premium that you pay. And that totals to 10%. Now, having laid out the framework of interest rates, let's come to the repo rate. Now, repo rate is also called the policy rate and is notified by the Reserve Bank of India. The governor, the RBI governor, post MPC, that is the Monetary Policy Committee meeting, which meets bi-monthly, announces the policy rate. So any change in the repo rate is a policy decision taken by RBI every other month. Now the repo rate is also what is called as the riskless rate or the benchmark rate. The reason is this sets the interest rates in the economy. Now, since this is a riskless rate, it merely consists of the real rate of return plus the inflation rate. No risk premium is added here. Now, let's go to the growth aspect of the economy. Now, the growth rate of the economy is propelled by consumption and investment. I think everyone is clear about that. Both consumption and investment consist of public and private aspects. So, when we talk about consumption, you have private consumption, that is what is consumed by the general public, and you have the government consumption, in the sense that consumption by the government institutions and departments. Similarly, when we come to investments, we have private investments and government investments, right? So having laid this framework, we can go ahead with our question whether repo rate has got to be cut or not. Now, I think when we talk about consumption, we must also remember that consumption demand depends on inflation rate in an economy. Higher the inflation rate, lower will be the consumption, or vice versa. Similarly, here again in consumption, you have rural consumption and urban consumption. Now, rural consumption would be dependent on the income of the rural population and the price of various consumption commodities. So, rural consumption is directly impacted by what is called as the rains, the monsoons, because rural population is directly dependent on agricultural income. And in our country, most of the persons working on the farmland depend on monsoon, even though we have a certain level of good irrigation facilities. And monsoon has got to be not only good and well distributed, it has got to be adequate monsoon so that Indian economy can grow, put money into the hands of the rural population, and the rural population can consume. When we come to urban consumption, it would depend essentially on jobs and wage revisions. And of course, prices of various commodities in the urban area. So, simply said, consumption consists of rural consumption and urban consumption, and both of them dependent on various factors which go to change or revise or alter or increase the consumption. When we come to investments, especially private investments, this would depend on the state of the economy. If the economy is doing good, there's a lot of confidence and there is a lot of expectation, and therefore the a greater deal of confidence in the political, social, and economic conditions of the economy. But one important factor that can impact private investment is the interest rates in the economy. So lower the interest rates, higher will be the private investments. Higher is the interest rate, lower will be the investments. Now, this is the broad framework that I have laid for you to understand so that it is easier to understand the arguments put forth by two MPC members about wanting a interest rate cut. That is, wanting a repo rate cut. Right? Similarly, when we talk about inflation, I know I'm confusing you with a lot of concepts, but if you understand these concepts, you will be able to understand how exactly the government of India, through Reserve Bank of India, is able to control inflation. Now, inflation has got two important components: core inflation and food and fuel inflation. And these two together are called as consumer inflation, or what is called as the headline inflation. Now, food constitutes about 57% weight in our retail inflation basket. So, I have given you, in short, what interest rates consist of and what your investment consists of, what consumption consists of, what is inflation. All these things have been able to give you in short. Now, let us see what the RBI mandate is. The RBI mandate is to keep the inflation within a narrow band of 2% to 6%. In other words, a target of 4% with a 2% leeway on either side. Now, the two MPC members have put a wonderful argument informing that it's important that we reduce the repo rate. Now, these are some of the arguments that they have made for recommending that recommending that the repo rate is pretty high and it needs to come down. The first argument is the real rate within the repo rate is pretty high. It's around 2%. And there is enough room for the RBI to reduce it by 50 to 100 basis points so that India can get into a higher growth trajectory or at least maintain the growth rate at 8%. The second argument they have said is food inflation, which is the major component of our headline inflation, is a supply side inflation having seasonal fluctuations and largely dependent on monsoon. In any case, food inflation cannot be controlled by monetary policy. So the glide path of cutting rates should be core inflation and not headline inflation. The third argument is today the inflation is dipping closer to the monetary policy committee's 4% target. So there is every scope for a rate cut. Now they said that in FY24, that is the last financial year, consumption growth was adversely affected by poor monsoon, weak agricultural growth, and relatively high inflation rate. Whereas in FY25, the conditions are expected to be more positive, favorable, especially on the inflation front, because we are expecting a really good monsoon. And they say that there has been a consistent, although cautious improvement in consumer confidence, business sentiments. Both are positive for consumption spending, whether directly or indirectly. So these members are confident that Indian economy has a potential to safely grow around 8%, but the nominal repo rate has to fall along with the projected decline in inflation, not the actual inflation, projected decline. And if the inflation continues to fall and expected inflation is approaching towards the target of 4%, it means that India can safely grow at 8% or 8% and a little above 8%. One other wonderful argument that they made was Indian real interest rate elasticity of aggregate demand is minus 0.21% or 21 basis point. Now, this suggests that if there is 1% rise in the real interest rates, other things being constant or equal, it reduces the growth rate by 21 basis point. And if you were to take this argument further, it says that between 2011 and 2017, India has almost sacrificed 6 to 7% of growth rate in view of a very high repo rate. One other argument made by the member is repo rate cannot affect the food prices. So keeping it above the equilibrium will not reduce the food inflation. And therefore, a positive real repo rate is adequate enough for the credibility of the monetary policy and anchoring the inflation expectations. And today, the real repo rate of 2% can have adverse effect on demand as well as worsen the supply side. So in short, the members have been saying that a positive repo rate of around 1% is currently adequate to establish MPC's inflation fighting credentials and keep inflation near the target. Having said all these things, they also made one other important point saying that today lending is risk based. Loans are small in size, capital cover is adequate, prudential or preventive regulations have tightened, and there is likely to be a pressure on the. There is it's very unlikely that there is going to be a pressure on asset quality, and there is no reason why repo rate cannot be cut at the earliest available opportunity. Now, of course, the MPC meeting will meet in the month of August, and that is the time we will come to know what the RBI plans are. Till then, let's wait and watch. Trust you have enjoyed this particular podcast. See you in another episode. Bye bye. Take care.